Hey guys, my name is Eric and today we are gonna look at the investment that might be best for beginners. It's very easy and quite safe for most people. We are talking about index funds, specifically ETF. So what the heck is index fund, Eric? Okay, let me explain. An index fund is a mutual fund or exchange traded fund designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. Okay, it sounds quite complicated, so let's try to explain it better. For example, one of the most famous index fund is called SP 500. Let's explain it very simple. In the stock market, you can own individual stocks. It's something like this. Let's say we own this company. It's one stock. If it happens to fail, if it goes under, we lose our money. That's why people do portfolio with more stocks so they can diversify the risk. Or you can buy index fund and you got, 500 largest companies in the US stock market and own them all. And this is basically owning an index fund. You got it all, like Pokemon. There are many index funds. For example, this is S&P 500, so it's 500 largest companies. Or you can own everything if you want. You can own every company in the world. Every company in the world in one basket. Even Warren Buffett thinks index funds are the best way for everyday investors to grow their money. And why? Because according to this report, 88.99% of large cap US funds have underperformed the S&P 500 index over 10 years. Data clearly shows that even professional fund managers are unable to beat the market consistently over a longer period of time. Even the experts can beat the market. Why would you? Index fund will give you huge diversification. For example, S&P 500, you are buying 500 largest companies in the US. It's like Apple, Amazon, Facebook, Tesla, Google, everything. 500 largest companies. It looks too good, right? There has to be some cash. There has to be some cash. This is not possible. Of course, like any investment, market can go also down. If we look at the S&P 500 annual returns, you can see in short term, you can lose a lot of money. So basically the best strategy is to go long term. If we look at the average annualized total return for the S&P 500 index over the past 90 years, it's 9.8%. It's almost like this 10% what we talked about in the previous video. This guy studied every 40-year period during that time. There were 48 of them, and the worst performing period yielded a compound return of 8.9%. So it means if you were in the past in the stock market and you would be in the stock market 40 years, and doesn't matter when you started, you would always get profit, always, in the past. Because not everybody has a 4-year investment horizon. He analyzed 15 years periods, highest 15-year performance with compound return of 18.3%. The lowest barely positive return was 0.6%. It was from 1929 to 1943. But this is still positive. There is no loss even in 15-year performance. And I guess he doesn't even count with dollar cost averaging, so it's much better then. Once again, to better understand it, guys, if you look at the returns from 1928, you can see profit, loss, 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 profit, loss, profit, profit, loss, 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 profit, 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 loss, 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 profit. So if you, for example, invest in 1930 and you sell it in 1931, you lost 50%. But if you think long term, you buy it here and you sell it there, you get so many profits that were bigger than losses. So it still looks pretty good, right? There is no but. You would say, this is so awesome. I will just wait and I will be always green. There is one more but. Don't forget that past doesn't create future. So what we see in the past, even 90 years, we don't know what's gonna happen. We don't know the future. We don't know. Maybe everything will crash and we will lose everything. You don't know. So you have to have this in mind as well. Nothing is guaranteed in investment world. You have to take always some kind of risks. Even now with the uncertain economic situation, with that corona, unemployment, bankrupts, you never know. But still there is one rule what I follow, and it's time in the market beats timing the market. Because nobody knows what's gonna happen. You don't know where it falls, you don't know where it go up. So it's better time in the market than try to time when I start investing. When, oh my gosh, it's gonna go up, it's gonna go up. I don't know. There are even some studies proving that time in the market really beats timing the market. And why is it so good investment for beginners? You are diversified. You can buy even whole market, all companies in the stock market. It's easy. It's super easy. You just buy it and hold it. You can even forget about it. You just don't do anything. If you are buying individual stocks, if you learn about investments like I do, I have to learn like 10 hours a day about it. And even that, like we talked today, index fund can perform much better than me with that all time in that, you know? But I love it, so that's why I studied. But for beginners, I think it's totally awesome. You don't need to read news, you don't need to read earnings reports, you don't need to read annual reports, you don't need to do anything. Just buy and hold, hold, buy a little bit, hold, buy, a little bit, buy, hold, and hold. And low fees. ETFs has really low fees. So let's be a little bit specific now. So what index fund should I buy? There is thousands of them. You have to choose. You have to choose your own. You can do your own research. You can Google best ETFs, or my personal favorite SP500 is VOO. And if you want to be a little bit more diversified than this, because SP500 is stock market, US stock market, so if USA goes under, if USA is like going downhill, you can still diversify a little bit more with international index funds or with bond index funds as well. Many people recommend this free fund portfolio. Let's say you can go 70% with US stock market, like VOO. You can even go with VTI, total stock market, not only 500, but total. Then you can go 20% for international stock market ETF, like VXUS. And you can go 10% with bonds. I don't have my favorite because I don't have bonds, so you gotta Google this one. Maybe BND, Vanguard Total Bond Market ETF, or Don't forget, guys, once again, that there is always a risk. Nothing is ever guaranteed in investment world. I gave you the information about this possibility, but you are the only one who has to do your own research and decide if it is the right option for you. I am not an expert, I am not a financial advisor, so a little disclaimer here. I don't see in the future, but with the data, I am pretty confident that in 20, 30 years, my portfolio will be much bigger. I will take my chances rather than letting my money get eaten by inflation every single year. I have some index funds in my portfolio, but I do much more investment strategies. But I can imagine that index funds can be totally great for someone who is just beginning. And maybe, like I said, you can maybe perform much better with your index fund, only index fund investment, than me with trying to, you know, figure out what company will be the next Tesla. So guys, thank you so much for watching today. I hope you enjoyed the video. Write me in the comments, what do you think about index funds? If you are an advanced investor, what do you think about it? If you are a beginner, what do you think about it? If you are super pro, what do you think about it? So we can learn all together here, like the community what I'm trying to build here. So thank you so much for watching. Don't forget to subscribe this channel. Maybe if you hit the like button, it will be nice as well. And I will see you in the next video. Bye.